Hi everyone and welcome back to my channel. Today we're going to talk about taxes for European and specifically capital gain taxes and dividend taxes. I feel like sometimes we forget that for Europeans the game is quite different compared to people that live in the US, where usually taxes are quite low for dividends and also for stocks, because also it's a system in which people have to rely more on extra income due to the huge amount of expenses that they have in terms of healthcare and pension. While Europe, in this sense, is kind of different because we have already high level of income tax that covers most of the pension and health costs that we have to sustain in the future. So applying the same system to Europe from the US would be wrong, especially if we don't look at what is the real cost behind our gains. So let's start. I would say we start with the capital gain tax. I have here a list of companies of countries in Europe with different capital gain tax and dividend tax. First of all, I would like to say I'm not a financial advisor. This is pure research that I did for myself. I am, as I said many times, a resident in Germany, so I know very well the tax system in Germany, but I cannot possibly know every tax system in every country in Europe or in the world, and whoever says that is a liar. So please, this is an indication of what could be the tax that you have to pay, or what would be the benefit that you can get from taxes, but do your own research in your own country and try to confirm this data, because this is not a topic that we should take lightly, I would say. Let's start then with the capital gain taxes. As we all know, capital gain taxes are taxes that are applied on the gain that we make out of buy and sell of shares. I'm talking only about the stock market in this case. So every time we buy a stock and we sell it and make a profit, we are subject to a tax from our tax institute in our own country. Before we go actually into detail into that, we have to remember that what it matters for your taxes is your fiscal residency. So it does not matter if you are French and live or Swedish or Brazilian. If your fiscal residency is in Italy, you will have to pay taxes in Italy, and you will have to pay taxes based on the taxation that applies in Italy at the time. Not Brazil, not France, not Sweden. So fiscal residency matters. So remember this. It's not your citizenship, it's the fiscal residency. Of course, there are some exceptions to this, but the general rule is this one. So if we look at the capital gain tax, you see that if we listed from higher to lower, we see that Denmark is actually one of the countries which is less profitable to do stock market gain, because we have a 42% tax. Again, this has to be confirmed, especially if you live in Denmark. Try to research and look into this. And then we have Ireland at 33% and so on. And we see that there are very cheap, I would say, countries for this, like kind of tax haven for stocks, like Luxembourg, Switzerland, Belgium, and also Netherlands. And so basically, it's a question also about is it really profitable for you to do the game of stocks when you are subject to 33 or 42% tax? Probably not. Probably you have to look at something different in this case, or probably you have to look if there are any ways of reducing this tax in your favor. Then, of course, there is something else called dividend tax. Dividend tax is a tax that applies to dividends that you receive from stocks. So I will maybe make a video in the future about what's a dividend, but basically, to make it simple, every time that the company has earnings, the company can decide either to reinvest the earnings for growth or take part of those earnings and give them to shareholders. And this is called the dividend. And also this money that basically gets into your account is subject to taxes, of course, because the taxes institutions, of course, they don't want always their their share of cake. And as we see also here, Denmark again leads the way. No, actually Ireland leads the way in this case with 51% tax on dividends. Denmark 42, UK 38, and so on. And we reach again situation in which Netherlands again is one of the countries with 0%, as well as Croatia, Greece only 5%. So um, it it shows you that whenever you can have like a very good amount of stock gain or dividend gain, but at the end of the day what you take home is the netto, no, it's the amount of gain you made without the taxes. So if we combine all of this, Ireland becomes a country very difficult to invest with for people that reside in Ireland, of course, I mean, with 84% total if we sum capital gain and dividend tax. So for this is not the effective tax rate, this is the only if we sum it. For example, we can play a game and check like what would be like to invest in Ireland. Let's say that we are in Ireland and we have, as we say, a capital gain of 33% and a dividend tax of 51%. So let's say now that we have a capital gain of 1,300 euro and a dividend that year of 300 euro. So remember, taxes are always applied yearly, so not monthly or weekly, it's on the year. So if we have 1,300 euro of capital gain, you will pay in Ireland 429 euro in taxes, leaving you with 871. And at 300 euro in dividend, you will pay 153 euro in taxes, leaving with 147. So if you make the total, you will have left 1,000 euro from your previous 1,600 gain that combine these two. So the effective tax rate will be around 36%. So you would say, how can I reduce this? Well, you know that capital gains are the ones that are taxed less if you live in Ireland. So I would say don't go into dividend stocks, then just go purely into capital gain stocks. Let's assume that this one is redistributed and we see that already we have 3% less tax rate and we're already at the lowest possible that we have. Then we can consider, of course, how can I reduce this? Like, there is any possible way that I can move this value down? Yes, you have to look if in your country there are deductions. So there are kind of ways to lower your taxable income. So deduction that I put here, it's like the amount of money that your country considers tax-free. And in Ireland, for example, there is a 1,270 euro tax-free allowance that can reduce your total amount from 1,600 to okay, this is wrong. From 330. And 330 becomes then the amount that is taxed. And if we tax it with the current taxation, that is 33%, you see that you pay only 108 euro, leaving you with 1,491 euro. So you see that from this start to the end, now we are seeing quite a big difference compared to before. So this is very important. You have always to look at this stuff. Don't think that there are no ways to pay less taxes or to have a relief. Even countries where taxation is very high, there are loopholes. There are like ways to find a benefit in the system that allow you to have a higher income. Okay, we can play another game and then say, okay, but what if I live in Switzerland or Netherlands? Then Netherlands has Switzerland, where was it? Switzerland has a capital gain tax of 0% and a dividend tax of 22.3%. So in this case, your effective tax rate, if you go pure in capital gain, is 0%. But if you want dividends, of course, then you will have to get taxed at 22%. And if you want, let's say if you want to go purely on dividends, then you will have to go to countries like, for example, Netherlands that has 0% on dividend, or Croatia that has 0% on dividend. And then you can see, okay, yes, I can build a dividend portfolio quite well, quite nice, because I will pay anyway 0% on it. Okay, so let's wrap it up then. We have like taxes that are based on your your fiscal residency, and these taxes are either capital gain tax or dividend taxes. But this applies 100% on companies that are they have the residence or that are from that country. So this 0% tax rate of Switzerland, this 22% tax rate of dividend on Switzerland applies on residents in Switzerland. but of Swiss companies. But what if you want to buy, you're a Swiss resident, you want to buy American stocks, which is what people usually buy the most? Then you have to consider that every time you get stocks from companies that are outside your country, you are subject to a withholding tax. And the withholding tax for US is 30%. Now, this means that every time you have, for example, a 1,000 euro dividend that you are supposed to receive from, for example, Coca-Cola, which is an American company, 30% of that dividend will be taxed already in the US, so will you receive already in your account 700. And so this applies for every other country, of course. Like if I live in Switzerland and I want Irish stock, then I will have a 25% withhold tax. If I want a French stock, 28%. If I want a Belgium stock, 30%. If I want a If I want a Greek stock, 5%. So you have to consider this when you do your calculation. You cannot just look at the dividend yield of a company or the fact that it's profitable, everything. You have to, that at the end of the day, what you keep in your pocket is what you made without the taxes. So after the taxes, that's what matters, not before taxes. And so you have to keep in mind this withholding tax. Now, we know that US has a 30% withholding tax, but there is something called double treaty system that allows you to don't pay twice the same tax. So usually US has treaties with every country in the world, so this 30% actually usually always drop to 15%. So this will be your official withholding tax that you would pay on American stocks. You have anyway 0% withholding tax in Indian companies, 0% in Brazilian companies, 25% in Canadian companies. But if you are European and you want to invest actually in European countries, I would go with the UK because you have withholding taxes of 0%. And one of the companies that I hold in my portfolio that is from UK is Unilever. Because not only I believe in the company, but it's also a company that I always get 0% withholding tax on it. So I always get the full amount of dividend in my account. And yes, at the end of the day, since I live in Germany, I will have to pay on the dividend that I made 26.4%. But hear me out, like, what is better? Is better to pay upfront a 26% tax or pay it the year after? It's always better to pay it the year after, because if you pay it upfront, you have already 26% less your money that you can reinvest. So if you consider this, it can become a snowball effect that affects your gains in the next 10, 20, 30 years quite a lot. So this is something to keep in mind. Like, diversify your portfolio in a way that you also can benefit from taxation relief from other countries. So I will leave this Excel sheet actually in the description so that you can take a look and play also with this tool to see what would be your effective tax rate and what would be the best strategy to fill. But then I will also talk about deduction. So as I said, this is something you have to consider quite a lot to reduce your taxable income. For example, I live in Germany, and I know that in Germany, for single people, the tax relief, the tax-free allowance is 801 euro. So if you make less than 801 euro, this is tax-free. But if I always consider this quite a reasonable amount, but then I look at the UK, and you have £12,000, which are tax-free. Congratulations to UK people. So up to 12,000 pounds, you are not subject to any kind of tax in the United Kingdom. Or like as we said, Ireland is 1,200 euro, 260 euro in Denmark. It's kind of difficult to find this value online because they're usually always in website with the original language, and actually I don't really speak Swedish or Belgium or Portuguese. But there are very crazy information. For example, French doesn't have a fixable amount of tax-free allowance, but it's based on the holding period. So I found an article actually that explains this quite well, where it says that first of all, the tax rate in France is not 30%. It's 30% if we sum up the capital gain tax, that is 12.8%, and the social security contribution that are 17.2%. Of course, then we get 30%. But you can get relief from this 12.8% if you hold your stocks for a certain period of time. In France, I'm talking about. So if you hold your stock for at least 2 years and less than 8 years, 50% of the gain that you made is tax-free. So you will not pay this 12.8%. If you hold for more than 8 years, then 65% of your gain is tax-free. So keep in mind these French residents, French people that have residence in France, that you actually have a big opportunity here to pay quite very few amount of taxes. Then we stumbled to Netherlands. Netherlands is one of the countries that fascinated me the most when I started research this thing, because Netherlands actually has 0% of capital gain and dividend tax, because Netherlands has a wealth tax only. So it has a 15% withholding tax for people that want to invest in Holland companies. But if you're a fiscal resident in Netherlands, you will never pay capital gain or dividend tax. You will pay them only if your stake on a company passes 5%. But to be honest, that's for a retail investor something that it's difficult even to imagine. Like imagine owning 5% of a company. Even for a small company, it would be quite hard to own 5% of it. Like imagine owning 5% of a company that is in the stock market is valued at 10 million euro. I mean, that's still 500,000 euro that you will have to own in that company. That's not something that the retail investor can simply do. So you have effectively 0%, and then you have a wealth tax. And how is calculated the wealth tax in Netherlands is calculated based on the amount that you own. So if you have up to 71,000 euro, this is how your money is split. 67% of those 71,000 euro is considered as saving and is taxed at 0.13%. The other 33% is considered as investment and is taxed as 5.59%. So effectively, in your 71,651 euro, you will have to pay 1.9% of tax. But hear me out, not finished. You have also a 30,000 euro free tax allowance. So you will have to take this 71 minus 30,000, and then you will pay 1.9% of wealth tax. So honestly, it makes me think like to move to Netherlands, this thing, but congratulations to everyone that lives in Netherlands. That's pretty good. This is from 2019, so if anybody knows, like, I will leave the link of this website in the description below for people that lives in Netherlands. It's something that you have to fill in this box 3. And here there is the explanation of everything. But of course, like, if you know that there is a new law, please let me know, and I will try to change this. So, as I said, to wrap up this video, please don't only look at companies based on their value, because because most of the time companies that you want to invest in are in the US. And remember, if you invest in the US, you have a 15% withholding tax on dividends. If you make capital gains, remember, for some places where you live, your capital gain tax might be very high. If you live in other countries, remember that you have some kind of relief that you can ask for. Don't forget to ask for this. Don't forget to apply for this. So be careful. You can, at the end of the day, what you take home is the after taxes gain. It's never the before taxes. Don't look at the before taxes gain. Look at the after taxes. There you can maximize a lot. So with that being said, I'll leave you for today, and I'll see you guys in the next video.